Ticker symbol SNA has had a pretty tough year. It has only returned around 5.5% since February 2023, but the thing is that throughout the whole year it has been trading up consistently, but recently they reported earnings and the market did not like it, so they traded down by around 15 to 20%. But today we'll be looking at a consistent dividend payer, which has a solid balance sheet. It has a 2.5% dividend yield with 14 consecutive years increasing dividends. So today we'll be looking at Snap-on Inc., which is a special tool company. They describe themselves as a manufacturer and marketer of tools, equipment, diagnostics, repair information, and system solutions for professional users. And the main industries that they target are vehicle repair, aerospace industry, the military, natural resources, and every single type of manufacturing industry. They divide the company into 4 reporting segments, the first one being Commercial and Industrial Group, the second one being the Snap-on Tools Group, third one being the Repair Systems and Information Group, and the final one being the Financial Services. And they outline their strategy as expanding their customer base in the automotive market, which is their main market, and adjacent markets, whether it's the aerospace one, the military, natural resources. And as well, they mentioned that they want to expand into different geographies. They do have one program which I'm really happy about, which is the Rapid Continuous Improvement. They call it the RCI. And here they focus on obtaining savings from efficiency and from improvements such as product design reductions, meaning that they design their products in order to have standardized parts so that they're less expensive to produce. Then they have manufacturing practices such as lean manufacturing and optimizing their network effects. And then they have a lower cost sourcing, so optimizing the way that they purchase the materials from suppliers, and even facility consolidations. So with their financial analysis, this company is pretty solid. It's not one of the best I have seen, but I do really like them, and I think this company has solid potential, especially when they have traded down for so much. First of all, they have a 14% return on capital employed, which is above the average. They have an interest cover of 21 times, meaning that they are not going to be affected by any short-term liability headwinds in the short term. And they have a cash conversion of 29%. This is the only metric that worries me, since in my channel we usually look at companies with a cash conversion of around 90%. And this is basically the number that means how well they are converting their net income into free cash flow. So I will be tracking this company to see if they actually are able to increase their cash conversion ratio. And they have a profit margin of 50% and an operating margin of 22%. This company has been able to grow their revenue, their gross profit, and their net income every single quarter since July 2021, and their gross margin and net margin have been extremely solid. As you can see, they have actually been trading up the margins, which is really good because it means that every single percentage of growth in revenue gets amplified into net income since the margin is higher. And how are they able to increase their net income margins? Well, as they produce more and more tools, they are able to increase their margins since they're able to, first of all, leverage economies of scale by purchasing more products to their suppliers, and they're able to bundle their products and obtain a higher price for them. This company works with almost no liabilities, as we have seen. Their asset to liability ratios are clear. They have a 3.5, which is way above the average, and it means that they are in a solid liability position. And they have a 0.3 debt to equity ratio, which means that, of course, they are very safe in this aspect, and they have a very solid balance sheet. Their efficiency ratios are trending pretty similarly to their margins. They are extremely stable, but are trending a few percentage up every single quarter. The one we like to focus here, apart from the return on capital employed, is the return on invested capital. And this has grown from around 23% in April or in July 2021, all the way above 25% in September 2023. It's a small increase, but this means that management knows exactly what they're doing, and they're doing the right things to make their business a better business quarter by quarter. Their dividends are extremely predictable, extremely consistent, and really safe. They're currently averaging a yield of 2.4%, which is in line with their average throughout the past years. One good thing to note here is that their dividend per share is increasing at a faster rate than their amount paid. And why can this happen? Well, this is because they're also conducting share buyback programs, which is another take on the fundamental analysis that we will be conducting in the next slide. So now moving on to that, this company gets a solid 7 out of 8, which is really good. First, they have low liability risk and a solid balance sheet, as we have seen in the previous slides, and they're extremely consistent with their cash flows, which is amazing since it makes them a safer dividend payer. Then, of course, they're providing great dividends, increasing them at a pretty good CAGR, and they have share buybacks into their programs. They have organic free cash flow growth, not because of their revenue growth, but because of their cost-saving initiatives. Here is why we put a cross on organic revenue growth. They have not been able to grow it at the pace I usually like my companies to grow it. Then the most important thing for a company I analyze is their moat. And this company ticks that box. They have an existing moat, a competitive advantage, and they're able to translate this into pricing power, since the majority of their customers are repeat customers and they have a very loyal customer base. This company has two main avenues for growth, the first one being the attracting new clients, which is the strategy they're currently pursuing, and the second one is the improving the offerings. I would say that by even consolidating their different tools that they provide, even offering more products so that the companies can have a sort of one-stop shop for all the provider needs, would actually improve the company's margins and their relationship with their current customers. This company has been trading at very low PE ratios for the majority of its history. It's trading at a 14 PE ratio right now, and that is sitting above its average. It's currently yielding a 2% free cash flow yield, and this also translates into the company being more expensive than what it should be, since this free cash flow yield is higher than the 3% long-term inflation rate. In terms of risk and possible challenges, I don't see any major risks and challenges that this company may face in the short term. One of the main ones I see is the competitor risk, and this is because it's not an industry where you can easily differentiate your offerings, since they are very standardized tools and components. So any company could come in, cut the costs, and able to take the customers from you. However, I do think that this company will be safe from that, since they have been working with the same clients for a long time, and they have a very loyal customer base. In terms of regulation, I don't see any major regulation affecting this industry in the near term, and in terms of performance, it is the biggest risk, since I think this company has a lot to do in order to be able to increase their revenue again. And in terms of market, I put a 30%, since I don't believe that there will be any economic downturn or cyclicality risks in the short term. One thing that I do have to say though is that since this company does work with the automotive industry very hand in hand, that industry is very cyclical, so this could affect their revenues in the long term. So please keep that in mind. Having said that, please remember I'm not a financial advisor and this is not financial advice, so please do your due diligence before purchasing the stock. All that said, I do believe that this is a good company since it has a strong competitive advantage, has predictable and resilient cash flows, and it has a high return on capital employed, meaning that it's good at creating value for the investor. So I believe that this will be a great investment, especially if the revenue starts growing faster. This, as well as improving their valuation as a company, will also expand their multiples growth, providing a double percentage increase for their prices. So thank you for watching. As always, this has been the Cashflow Compounder. There is a link in bio for you to join the free Patreon for extra content, and there is a link in bio for our free stock if you join Trade Republic or Trading 212.